Good morning. It's June 5th, 2023. Today, we're going to head over to the Longbow dashboard to the Doomsday Dozen. We've actually gotten calls from around the world on this one, including a really good conversation with the VC out of India about the Doomsday Dozen. And today, we wanted to show you that we're at 84. So it hopped back down and kind of see that we were here, into the 60s. So we had some better times if you wanted to stay, much more long in equities and risk assets, but now we're popping back up. We're at 84. So it's really not the time to be adding equities. Again, just as a friendly reminder, this is a weighted score of the 12 underlying signals that we show you here. And what are we seeing, if we're going to go down is that, there's strong market momentum. So that's when the S&P is looked at versus its 125-day moving average historically. We've also got really strong market strength. So there's a high number of stocks hitting 52-week highs versus low. So that gives you greed and extreme greed. So when everything's going super well, that's usually not the time to pile in, especially when you're looking at potential additional rate hikes. What it may not be in June, but it could be in July. Inflation is still high. Yes, we've had some lower service, PMI, ISM, those kind of readings. And from a macro standpoint, but still labor is hot, wages are hot, a lot of inflationary data is hot. So we want to be looking at each of these things individually, but then collectively as we weight them for you. So we kind of do the math for you here and give you a visual to say red, green, pretty good. So you remember we were here in the fall, that was an easier time to make the call. Like, gosh, we could really have an upward swing. It was a non-consensus view back then, but now when everyone's throwing in the towel, getting in equities, jumping on the AI train, that's usually not when you should be doing it. We're going to look at market breadth. So the volume stocks trading up versus down. That's a little bit more in the fear category here. So it's kind of, but doesn't have a very strong signal strength. So it's kind of more of a neutral, same thing with equity put call, much more neutral standing from the investor base. But volatility, extreme greed, you can see with the VIX coming down. If you look at historically, then it's at a very low level. Obviously not when it was at 9, 10, 11, in the last decade plus, but in more recent years. And if you're looking at a more deflationary environment or somewhat inflationary environment with slowing growth, this isn't what you really want to see is vol coming down. That tends to mean that people are getting complacent. Junk bond demand, though, shows a little bit of fear, but extreme greed, again, on safe haven demand. So people buying, if you're looking at, call it S&P versus TLT, people are going for risk. They're not going for safety. So it's an extreme greed and pretty strong conviction level on that signal. And the vol versus vol, so how much is volatility moving versus the volatility of itself? And that ratio is showing greed. A global PMI, extreme greed. And then, you have some fear and yield inversion, but we've been dealing with that for so long, I think people have given up. And volatility thresholds, it's a proprietary signal based on volatility metrics. That's really in the neutral camp. To kind of add all these things together, you can look at them down here, look at them historically if you want. You can see what the signals are historically. We show that to you, and we give you the answer right there. But I'm going to pull back up and say, all you need to do is think about driving a car, and you're probably going a little too fast right now. So, take the foot off the take the foot off the gas, off the pedal. Be careful right now. This is not the time to be adding risk. Take care.